The Federal Central Bank, or the Federal Reserve Bank, is the bank of all banks. It has regulatory authority over other banks, sets monetary policy. Omo, Dr. Arf Arf, Miss Earrig at ad plate gobbled up. An example of that would be buying bonds increases.
The four tools are open market operations, OMO, buying and selling bonds, which increases money supply, lowering interest rate on bonds, will raise resources and money supply. The second one is discount rate, interest rate banks pay to Federal Reserve, decreasing the discount rate increases bank borrowing, which increases amount of money for loans. The third is reserve requirement, the amount of money banks required to keep, which is a part of our fractional banking system, and the multiplier is 1 over the reserve requirement. And the fourth is the federal funds rate, which is interest rates banks pay commercial banks, sets and adjusts money supply. Cause and effect for expansionary monetary policy, aka easy money. When this policy is used, the central bank is attempting to increase the money supply. Buying bonds decreases the discount rate, which decreases the reserves rate and the federal funds rate, which increases money supply, decreasing interest rate, increasing government spending, aggregate demand, price level, GDP, and decreasing underemployment. Buying bonds causes an increase in money supply. Decreasing the discount rate causes an increase in bank borrowing and money supply. Contractionary monetary policy, aka tight money, is when the central bank is attempting to decrease the money supply. They sell bonds, which increases the discount rate, the reserves rate, and the federal funds rate, which decreases the money supply, increasing the interest rate, decreasing government spending, increasing aggregate demand, price level, real GDP, and decreasing unemployment. When the central bank increases the discount rate, it reduces bank borrowing, lowering the amount of money for loans and the money supply. Impact on money market graph and aggregate supply, aggregate demand. For aggregate supply, aggregate demand, if the government sells bonds, the interest rate increases, causing a decrease in consumer spending and aggregate demand. For money supply, or for the money market graph, money supply is controlled by the Federal Reserve, and if the government buys bonds, the money supply increases.